It didn't begin with headlines. In fact, Warren Buffett's first warning came from something far more subtle, a change in how capital was moving through energy markets. Not a collapse, not a surge, just a realignment, one so minor that casual observers would have missed it entirely. But for Buffett, it triggered a quiet alarm. He'd seen this pattern before in the early 2000s during the post-Enron volatility, and again in 2008 when financial firms began repositioning days before the collapse of Lehman Brothers. This wasn't panic, this was preparation, a measured, strategic reshuffling of exposure. The red flag appeared when institutional portfolios with heavy stakes in U.S.-based oil logistics began diversifying into more neutral international holdings, not because of global demand, not because of price per barrel fluctuations, but because of rising uncertainty around domestic policy risk, specifically policy risk connected to one man, Donald Trump. Buffett wasn't watching the news cycle, he was watching the spread. Commodity futures in Brent and WTI began diverging in ways that couldn't be explained by supply-demand fundamentals alone. Risk spreads on shipping insurance spiked marginally, just enough to suggest that geopolitical volatility was being priced into American-linked contracts, and then came the trigger. A series of last-minute PAC donations from energy sector holding companies with shadow links to foreign refineries. The filings were public. The names were familiar to those who follow campaign finance, but what stood out to Buffett wasn't the donations themselves, it was the timing. The capital moved in just after Trump hinted at new retaliatory tariffs on nations manipulating oil prices. A message that played well at rallies, but sent shockwaves through the boardrooms of his own donor class. Buffett knew what that meant. These weren't donations made out of patriotism or ideology. They were political hedges, bets placed to preserve deregulation, drilling rights, and favorable tax codes. And when those bets started to shift, it meant the high-level donors were recalculating. That morning in Omaha, the phones were unusually quiet. The markets weren't crashing, but the energy sector showed a subtle wobble, not in share prices, but in allocation strategy. Buffett, who has spent a lifetime studying incentives, understood what the silence meant. Smart money, he once said, doesn't shout, it reallocates. He called one of his long-standing contacts a portfolio manager with deep roots in global oil infrastructure. What he heard confirmed his suspicion. The manager said some of the offshore entities tied to U.S. PACs are reassessing their exposure, not just financially, but politically. Buffett didn't need a second opinion. What he saw unfolding was bigger than a tariff debate. It was the early unraveling of trust between foreign-tied capital and Trump's political machinery. A trust that had been built on stability and now was being tested by unpredictability. To most Americans, the connection between campaign donors, energy markets, and foreign interests is too tangled to follow. But to someone who views markets as incentive machines, where every decision is ultimately about risk, the signs were unmistakable. And so Buffett spoke, not with names, not with accusations, but with clarity. When the people who backed you start to hedge against you, he said, the real story has already begun. It wasn't a statement meant to stir controversy. It was a financial truth the kind markets understand long before the media catches up. And that moment, the realignment Buffett detected from his desk in Omaha was the start of something far larger, something the Trump campaign never wanted in the open. When most people hear the term foreign influence, they picture espionage or scandal. But in modern finance, influence doesn't need a passport. It moves silently through shell companies, investment vehicles, and multi-tiered ownership structures, all designed to stay legal, but strategically invisible. That's where this story gets complicated. Because when campaign finance reports for Donald Trump's recent fundraising cycle were quietly released, they showed something that didn't trigger alarms for most reporters. To the untrained eye, these filings looked routine, large. Donations to PACs, bundled contributions, a handful of well-known firms writing six-figure checks. But to a financial analyst or someone like Warren Buffett, the real story wasn't in the amount. It was in the architecture. Several of the PACs supporting Trump's 2025 campaign received substantial contributions from holding companies that, when traced back through public disclosures and international registries, revealed partial ownership by firms based overseas. Not foreign governments, not direct entities, but private conglomerates with significant assets in the Gulf, Southeast, Asia, and even parts of Eastern Europe. These companies were diversified on paper: shipping, energy, logistics, private equity. But they had one thing in common: exposure to U.S. energy infrastructure and American trade policy. Buffett's team didn't uncover some deep state conspiracy. What they saw was more telling: a cluster of corporate donors with cross-border financial incentives who stood to gain or lose billions depending on how Trump handled tariffs, export restrictions, and environmental rollbacks. And then the pattern emerged. The timing of these donations closely followed key policy announcements, most notably Trump's public threats to renegotiate oil import-export dynamics and impose penalties on countries gaming the system. The irony? Some of the PACs receiving foreign-tied donations were simultaneously funding messaging about America First energy independence. That dissonance wasn't just ideological, it was strategic, because these foreign-linked donors weren't buying into Trump's nationalism. They were betting that his volatility, his habit of bypassing bureaucratic process, would continue to create loopholes, deregulations, and favorable conditions for high-risk, high-reward investment plays. But volatility has a cost, and the more erratic Trump's energy and trade policies became, the more exposed these donors were, not just politically, but financially. A surprise announcement could tank the price of refined exports. A sudden tariff threat could trigger currency moves that wiped out entire quarterly gains. This is when Buffett's warning started to gain weight. You see, these weren't ordinary political donors. These were finance professionals, people who measure ROI in basis points and think in cycles, not slogans. They didn't mind playing the political game, but they expected returns. And when those returns became uncertain, their calculus changed. That's why their donation patterns became so revealing. In late October, two PACs reduced their scheduled disbursements by nearly 40%, citing internal realignment of strategic priorities. But when those PACs were traced back to holding companies with minority ownership by an Abu Dhabi-based energy firm, the message was clearer than the language suggested. Trump had become a risk factor, and for Buffett, this was the part most people missed. It wasn't about legality. The donations were allowed. The firms had U.S. registration. Everything was technically compliant. But the incentives were foreign. And when the incentive structure behind a domestic campaign is being shaped by entities overseas, not in secret, but through quiet, legal channels, then the core foundation of that campaign is no longer stable. It's leveraged. And in Buffett's world, anything over-leveraged eventually has to settle its balance sheet. Warren Buffett doesn't often wade into politics, and when he does, he doesn't shout. But this time, his words didn't just enter the national conversation, they quietly redirected it. He wasn't on a talk show. He didn't drop a name. He didn't even hold a press conference. He simply made a calm observation delivered during a private briefing with investors in Omaha and later echoed during a Q&A session with a financial publication. The comment was short. When your donors lose billions on your policies, they don't stop donating because they're angry. They stop because the math no longer works. That one sentence rippled. Within hours, economic journalists began combing through recent market activity and comparing it to donation cycles. Several hedge fund analysts reposted the quote on financial Twitter, some adding charts showing how energy stocks tied to Trump's donor network had taken hits in the wake of recent policy shifts. It wasn't that Buffett had revealed a scandal. He had revealed a contradiction. Here was a candidate, Donald Trump, who had built his financial war chest on the promise of protecting business interests, especially energy, especially deregulation, especially the types of multinational donors, who stood to gain the most from a predictable, pro-business environment. And yet, those very donors had just taken some of the hardest hits in the market. It wasn't just oil and gas. It was steel, shipping, infrastructure, and energy logistics, the sectors most sensitive to tariff risk and Dallas-Gunite geopolitical instability. And it was becoming clear that Trump's erratic policy moves, often announced without warning, were hammering the portfolios of the people bankrolling his campaign. Buffett hadn't exposed them. He'd simply framed the financial truth in a way no one had done before. And that was the shift. Within 48 hours of his remarks, multiple headlines followed. Buffett, Trump's donors are losing big. Did Trump just cost his own campaign millions? Warren Buffett connects policy volatility to donor withdrawal. But the real damage wasn't in the headlines. It was in the whisper network, boardrooms, strategy calls, quiet lunches between fund managers and political consultants. Suddenly, high-level donors were facing questions from within their own firms. Why had they bet so heavily on a candidate who couldn't deliver stability? Were their political contributions now considered a liability? Would continued support signal incompetence to shareholders? These weren't ideological debates. They were fiduciary ones. And Buffett's words had created a framework, a clean, apolitical diagnosis that exposed the cracks between political loyalty and financial responsibility. Behind closed doors, some of Trump's donors reportedly bristled, not because they disagreed, but because Buffett had spoken the truth out loud, a truth they had hoped wouldn't surface until after the election. Because once that truth was public, the media no longer needed leaks. They had the narrative, and once a narrative is born, it writes its own momentum. What made Buffett's comment so potent wasn't that it revealed a new fact, it reframed existing facts in a way that reoriented the political lens through an economic filter. It took the story away from ideology, away from partisanship, and planted it squarely in the center of business logic. That's when the donors got nervous, because now every dollar they contributed could be scrutinized through the lens of risk exposure, and every market loss could be traced back to the man they were backing. Buffett hadn't started a war. He'd just shown everyone the scoreboard. And for a candidate who built his brand on winning, that was the most dangerous kind of silence breaking imaginable. To understand why foreign exposed donors would place large bets on Donald Trump, you have to stop thinking like a voter and start thinking like an investor. These weren't idealists. They weren't backing him for his message or media dominance. They were backing him for one reason: return on investment. In their world, political contributions aren't about ideology. They're business decisions, structured, strategic, and heavily modeled for risk. At first glance, it might seem counterintuitive. Why would entities with foreign stakeholders support a candidate known for his protectionist rhetoric, a man who campaigned on tariffs, trade walls, and putting America first? Because Trump didn't just bring conflict, he brought access. During his previous term, he dismantled environmental protections, fast-tracked drilling permits, weakened foreign investment reviews, and used executive orders to bypass regulatory hurdles. For fossil fuel companies, logistics conglomerates, and foreign-tied shipping firms, this wasn't chaos, it was opportunity. Unlike traditional candidates bound by slow-moving policy pipelines, Trump had a governing style that favored the abrupt, slashing taxes, pulling out of agreements, rewriting executive rules overnight. That unpredictability spooked the markets, but for insiders with the right access, it also opened rare windows to lock in outsized gains. And many of the donors now under scrutiny had exactly that access. Through lobbying arms, bundled PACs, and high-level consulting firms, these entities built bridges to policymakers inside the Trump orbit. They weren't just betting on deregulation, they were helping write the playbook. And in return, they gained ground. New export routes, expanded federal leases, loosened emissions thresholds, and trade exemptions carved out just wide. Enough for them to squeeze through. The most influential foreign-aligned donors operated through holding companies legally registered in the USA, a maneuver that gave them political cover while maintaining overseas exposure. It allowed them to fund campaigns under U.S. rules while reporting quarterly gains to foreign shareholders. It was a win-win until it wasn't. Because Trump's greatest political weapon, his volatility, became their greatest business risk. His tweet-driven policy shifts began moving markets faster than their analysts could adapt. A single announcement on tariffs or foreign oil policy could wipe out hundreds of millions in commodity positions. LNG terminals in the Gulf saw shipments stall. Currency-dependent deals unraveled within hours, and yet many donors stayed. Why? Because their long game was still in play. They weren't looking for stability, they were looking for control. With Biden's administration reintroducing regulatory guardrails, and with European markets turning green, Trump represented a rare remaining avenue for full-spectrum deregulation. A second term, they believed, could bring even more aggressive policy, rollbacks especially on climate, foreign investment restrictions, and energy exports. For donors tied to Saudi, Emirati, or Singaporean capital, this was a unique window to extend influence over American infrastructure, ports, pipelines, refineries, under the banner of economic nationalism. Trump gave them access to American soil while distracting the public with anti-foreign rhetoric. And the media didn't catch it until Buffett spoke. His commentary didn't accuse anyone directly, but it forced a question that donors never want asked. Why are foreign-tied companies backing a candidate whose policies claim to be anti-globalist? The answer, of course, is simple. Because the campaign was never anti-globalist. It was anti-regulation. And for donors looking to extract short-term profit, that made Trump the perfect tool, an agent of disruption that allowed them to operate faster, riskier, and in the shadows. Buffett understood this dynamic better than anyone. He knew that capital doesn't care about borders. It flows toward opportunity, regardless of flags or speeches. And when that opportunity started costing money, the foreign exposed donors who once saw Trump as an asset began to see him as a liability. But by then, the architecture had already been built. And now, with the spotlight widening, that structure, silent, legal, but deeply compromised, is finally being revealed. For weeks, tension had been building beneath the surface. Financial markets were already jittery. Energy sector stocks were whipsawing. And inside the tight circles of political finance, a question was quietly circulating among high-level donors: what will Trump do next? Then, without warning, the answer arrived. Standing on a rally stage in Ohio, Donald Trump unveiled a sweeping economic policy shift. He declared that if re-elected, his administration would impose targeted export controls on domestic energy companies that, in his words, were cutting deals with our enemies. It was a headline-ready statement crafted for applause. But to donors in oil and gas, logistics, and shipping, particularly those with foreign-linked exposure, it landed like a financial bomb. The panic wasn't about politics. It was about math. Many of Trump's largest energy-linked backers, especially those routing funds through U.S. holding companies with offshore portfolios, were actively operating in the exact countries he was now threatening to sanction or restrict. Some were shipping liquefied natural gas to Asia. Others had joint ventures with Middle Eastern refineries. A handful were financing infrastructure deals in Africa and South America, all regions Trump vaguely referred to as markets where American dominance is being sold out. Within 48 hours, equity positions tied to U.S.-based international shippers dropped by over 4%. Offshore hedge funds began hedging against Gulf Coast refinery profits. And in private emails, compliance officers at multinational energy firms began reassessing political risk exposure not to foreign governments, but to the U.S. president they had just funded. Warren Buffett, watching from Omaha, didn't panic. He analyzed. The move, he later explained, was a classic example of policy volatility masquerading as economic strategy. It had all the hallmarks of a reactionary shift. No congressional backing, no regulatory infrastructure, no legal analysis, just a declaration amplified by the press that instantly altered the economic assumptions of billion-dollar industries. And that's what caused the real damage. Because in finance, risk isn't just about what happens, it's about what might happen next. And when Trump threatened to weaponize energy exports, he crossed a line that most high net worth donors fear more than taxation: unpredictable interference in global contracts. You see, for most of these foreign exposed donors, American energy policy wasn't a liability. It was their anchor. The U.S. regulatory environment, even under Trump, had long been a stable playground for risk-managed profit. Sure, there were noise and headlines, but beneath it all was a framework: agencies, lawyers, safeguards. This time, that framework was skipped entirely. Trump's statement bypassed every traditional channel: no consultation with the Department of Energy, no formal input from the U.S. Trade Representative, just a rally stage, promised to punish American companies doing business abroad. For some voters, it was red meat. For donors, it was a red alert. The real panic didn't hit the markets immediately. It hit the private Slack channels and Bloomberg terminals of companies managing foreign shipments. Suddenly, capital began freezing, not because they feared enforcement, but because they couldn't calculate enforcement. Would the policy be formalized? Would it affect existing contracts? Was it even legal? The uncertainty was toxic. And Buffett, never one to exaggerate, framed it simply: markets can price risk. What they can't price is a leader who changes the rules mid-game. By the end of the week, several donor-backed PACs quietly paused their media buys. A mid-tier logistics fund postponed a new round of contributions. And one energy executive, speaking off the record, told a reporter, "This isn't policy anymore, it's roulette." And that's how it started. Not with a collapse, not with a leak, but with one sentence from a podium that changed the entire equation. Warren Buffett's office in Omaha is not a place where political operatives normally reach out. It's far removed from Washington, disconnected from media theatrics, and buffered by decades of disciplined financial focus. But when the markets get nervous, especially the people behind them, that's when the phone starts ringing. And this time, it rang quietly. The calls didn't come from journalists. They came from people who don't speak on record: political donors, strategic advisors, board members at multinational energy firms, former government officials with current ties to high net worth families in the Middle East. Each call had a different voice, a different tone, but the message was the same: Warren, they're spooked. The first call came the morning after Trump's off-script rally comment about punishing American energy companies doing business with our enemies. The phrase, vague as it was, reverberated instantly through the donor class, not because of its policy weight, but because of its financial implications. One caller, an executive tied to a global investment firm with exposure to Saudi and Qatari oil operations, didn't mince words. "My people are not worried about politics, they're worried about asset security." He meant it, literally. Millions of dollars had just been allocated to expand U.S. shipping terminals on the Gulf Coast, a move predicated on Trump's prior deregulation promises. But now, with this sudden shift in rhetoric, those same investors were questioning whether they could even fulfill their export contracts without drawing political fire. They weren't concerned about Biden. They were concerned about the man they had backed. Another call came from a longtime political consultant who had advised donors during multiple Republican cycles. He'd spent months assuring clients that Trump's volatility was controlled, that despite the noise, policy stayed within predictable lanes. Now, he was walking that back. "I need to ask you something," he said to Buffett. "Do you think the markets are overreacting to this? Or are we about to see the money dry up?" Buffett didn't answer right away. He listened. He always listens first. Because in finance, people often reveal more through their anxiety than through their intentions. What he heard over and over wasn't anger, it was hesitation. These were donors who had spent the last 2 years carefully building financial structures to support Trump without appearing too exposed. They had routed funds through U.S.-based PACs. They had used consultants to distance themselves from operational decisions. They had even hired lobbyists to pre-spin narratives in case anything leaked. But what they hadn't accounted for was Trump turning on the very industries they thought he championed. Buffett took it in stride. He knew this wasn't the first time political donors were caught off guard, but it was perhaps the first time the foreign-linked capital behind those donors had begun questioning its entire risk profile. Because once a candidate becomes a liability to his own financiers, it's no longer about ideology, it's about exit strategy. One executive summed it up best during his call with Buffett: "We don't need guarantees, but we need guardrails," and he just removed them. For Buffett, that comment said it all. Markets don't collapse because of noise. They collapse because confidence erodes slowly and then all at once. And in this case, the erosion had started in silence, not through speeches, not through editorials, but through whispered calls to Omaha, calls from the same people who just months earlier were celebrating Trump as their economic firewall and were now wondering whether the firewall had become the spark. The phrase foreign influence often conjures up images of espionage, backroom meetings, or illegal wire transfers. But in modern American politics, foreign exposed capital doesn't arrive in the shadows. It arrives with compliance teams, legal frameworks, and perfectly polished documentation. It's not the illegal money you should worry about. It's the legal money that's engineered to appear domestic but answers to global interests. In recent election cycles, campaign finance has evolved into a complex web of influence, shaped by layers of corporate ownership and multinational portfolios. A political action committee, PAC, might receive a sizable donation from a Delaware-based LLC. On paper, everything checks out. The company is registered in the U.S., operates within regulatory bounds, and discloses its contributions as required by law. But peel back just a few corporate layers and you'll often find that the LLC is partially owned by an investment fund with headquarters in Dubai or backed by a board of directors based in Singapore or structured around assets controlled by a sovereign wealth fund in the Middle East. This isn't a conspiracy, it's a strategy. Foreign exposed capital can legally shape U.S. elections as long as it follows the form, even if the intent falls into murkier territory. The loophole lies not in secrecy, but in proximity. So long as the entity writing the check is technically American, the ultimate beneficiaries of the policy outcomes may reside anywhere in the world. That's what made the Trump campaign so attractive to certain foreign-aligned donors. His administration had shown a willingness to deregulate at speed. Environmental rules rolled back overnight, export controls rewritten by executive order, oversight on overseas assets largely ignored. For companies with global exposure, Trump wasn't just a candidate, he was a bypass mechanism, a way to skip layers of red tape and open lucrative doors in record time. Energy firms with foreign ownership stakes recognized this early. Rather than directly funnel funds into Trump's campaign, which would raise flags, they used U.S.-based intermediaries. These firms, often set up as shell corporations or holding entities, contributed to PACs aligned with Trump's political goals. The contributions were perfectly legal, yet the policy payoffs they sought were designed to benefit international markets, pipeline deals, offshore drilling rights, LNG exports, and energy, arbitrage across borders. And Trump's campaign welcomed the money. But this relationship came with one major risk: volatility. Because these donors weren't betting on rhetoric, they were betting on predictability. They expected returns, not just in tax savings, but in regulatory relief, infrastructure access, and a White House that wouldn't interfere with their cross-border operations. And that's where the problem began. As Trump's policies became more erratic, swinging from trade war threats to last-minute tariffs to unpredictable foreign policy statements, the very capital that had once supported him began to falter. These donors had modeled a risk curve that assumed stability through chaos. But now the chaos was eating into profits. That's the hidden vulnerability in foreign exposed influence. It's not about ideology, it's about control. And when the asset, in this case the candidate, becomes too unstable to manage, the capital starts searching for alternatives. Some donors pulled back entirely. Others began whispering to other campaigns. A few doubled down, hoping Trump would return to form. But for Warren Buffett, the shift was already happening. In a private briefing, he noted, "Political capital is no different than financial capital. If it's exposed to volatility without hedges, it withdraws." And that's what the world began to witness. Not an overt scandal, not a dramatic collapse, but a strategic retreat as foreign-aligned donors, once eager to shape American policy through perfectly legal contributions, suddenly found themselves recalculating the risk of being too close to a candidate who no longer behaved like an investment. In politics, as in investing, the most dangerous problems are the ones that remain unseen until they can't be ignored. For months, the donors behind Donald Trump's campaign had been operating with confidence. Their financial models had accounted for volatility. Their PR consultants had crafted narratives. Their lobbyists had secured footholds in the right rooms. But there's a moment every investor fears, when a silent liability becomes a visible threat. That moment came when Trump's policies, once a source of speculative advantage, began backfiring in measurable, undeniable ways. It wasn't just the markets reacting, it was the headlines, the hearings, and most importantly, the math. Suddenly, portfolios that had previously weathered the storm started to show cracks. LNG contracts were paused due to uncertain export regulations. Overseas shipments were delayed as new tariffs were floated with no warning. Refineries that had once enjoyed quiet exemptions now faced the real possibility of political scrutiny. The risk had always been there, but now it had a face, a price tag, a timestamp. And in finance, visibility changes everything. Warren Buffett often says that markets hate uncertainty, but there's a more subtle truth behind that idea. Markets hate visible uncertainty even more because once a risk becomes public, it forces everyone from asset managers to analysts to political donors to act, or worse, to explain. For the foreign exposed donors behind Trump, that visibility came in layers. First came the media attention. Analysts began publishing reports connecting campaign donors to companies hit hardest by Trump's policy shifts. Think tanks published breakdowns of PAC contributions, showing a clustering of capital around deregulation-dependent industries. Then came the financial data. Quarterly earnings reports from several energy logistics firms showed significant losses tied directly to tariff exposure and policy whiplash. For some, those numbers aligned exactly with Trump's public statements, right down to the day. And finally came the optics. News outlets started running pieces with titles like, "Are Trump's donors paying for their own pain? Why energy tycoons are getting nervous. Buffett's quiet warning. The donors in the crossfire." The questions weren't theoretical anymore. They were being asked on live television, in investor memos, and behind closed doors during emergency board meetings. Suddenly, the donors were no longer just funders. They were risk profiles. Some tried to double down, offering more money in hopes that greater access would buy more stability. Others tried to distance themselves, quietly diverting funds towards super PACs not directly associated with the Trump name. But all of them were doing the same thing, recalculating. They had once believed that Trump's volatility was the price of deregulation, that every shock wave was a negotiating tactic, that the chaos was controlled. Now, they weren't so sure, because when risk becomes visible, it becomes contagious. Investors notice, journalists connect dots, shareholders ask questions, regulators start looking harder, and campaign finance becomes more than a spreadsheet, it becomes a vulnerability. Buffett understood this instinctively. He had seen it. Before, in the collapse of over-leveraged hedge funds, in the implosions of politically exposed banks, and in the unraveling of companies that thought they could outrun transparency. Visibility, he often says, doesn't kill a deal, but it changes how the deal is viewed. And in this case, it changed how Trump's donor network was viewed, not as a source of strength, but as a warning light in the dashboard. By the time risk became visible, it was already too late to hide it. The markets had priced it in. The narrative had shifted. And the question wasn't whether donors were losing confidence. The question was how much longer they were willing to wait before pulling out completely. Because in both investing and politics, once everyone can see the risk, the smart money is already gone. When high-level donors decide to pull out of a political campaign, they don't slam the door. They dim the lights, walk out quietly, and make sure no one hears their footsteps, especially when those donors are connected to foreign capital. In October, a series of subtle but telling signals began emerging from the donor ecosystem surrounding Donald Trump's campaign. There were no press conferences, no high-profile denouncements, just small, precise changes, easy to miss if you weren't watching closely. But Warren Buffett was watching, and to him, it was unmistakable. The exits had begun. One of the first signs came from a super PAC that had long been a reliable vehicle for energy-linked donations. In previous cycles, this PAC had poured millions into pro-Trump ad campaigns, policy white papers, and state-level mobilization efforts. But this quarter, its financial disclosure revealed a sharp decline in incoming contributions, down nearly 38% from the same period a 24-45 year earlier. The reason? Internal realignment of donor priorities, according to the filing. In plain English, that meant the money was being redirected or withheld. Buffett knew that language well. When a donor stops writing checks, they rarely say why. But when multiple PACs begin citing strategic reassessments in their filings across different industries, with overlapping financial exposure, the picture becomes clear. They weren't abandoning Trump because they disagreed with his message. They were backing away because they no longer trusted the bet. Behind closed doors, this shift was even more pronounced. In fundraising circles, donors with ties to foreign energy and shipping conglomerates began postponing scheduled contributions. Events were canceled, invoices delayed, and calls to campaign finance managers went unreturned. In several cases, donors who had previously committed to bundled donations quietly rerouted those funds into more neutral Republican-aligned causes, still on the right, but no longer tied directly to Trump. It was, as Buffett described it in a private meeting, a classic case of political hedging. These donors weren't going left. They were going sideways. They still wanted influence, still needed access, but they were no longer certain that Trump was the safest channel to get it. His unpredictability had gone from a tolerable variable to a measurable liability, and liabilities demand adjustment. One executive at a logistics firm with indirect ties to a Middle Eastern sovereign wealth fund told a political strategist the following: "We didn't expect Trump to be stable, we expected him to be profitable. Now he's neither." That single sentence captured the mood perfectly. And yet, none of this was public. That was the brilliance of the exit strategy. Donors didn't want headlines. They didn't want to draw fire from Trump's loyal base. What they wanted was distance and the flexibility to re-enter if the tides shifted again. So they did what sophisticated capital always does. They slowed, diversified, and hedged. PACs pivoted to issue-based advocacy instead of candidate-specific spending. Political consultants were reassigned from battleground messaging to long-term policy work, and offshore-linked holding companies began quietly reducing their U.S. exposure in energy futures, citing geopolitical climate risk. Buffett saw the whole playbook unfold from Omaha. To most people, it looked like nothing, but to a man who has watched trillions move through silence, the message was loud and clear. The confidence was gone, and once confidence leaves the room, money follows. The Trump campaign, publicly defiant as ever, continued to project strength, but insiders knew. The machines were still humming, but the fuel was starting to run low, and the donors, they weren't waiting for an official collapse. They were already walking backwards slowly, strategically, and with enough deniability to pretend they never left. Because in high-stakes finance, the smartest exits aren't the ones you announce. They're the ones no one notices until you're already gone. Inside the Trump campaign, denial is not just a reflex, it's a strategy. For years, his political machine had relied on an aura of invincibility. Even when scandals broke or polls dipped, the message was always the same. We're winning, the base is loyal, the money's strong. But behind the curtain, things were shifting. And for the first time in months, Trump's inner circle was forced to confront a problem they couldn't spin away. The donor class was losing faith. The earliest warning signs came not from outside advisors or journalists, but from fundraising staffers, the people who track every dollar, every call, every canceled check. In early November, they began noticing strange patterns. Donors who had previously committed to six-figure packages were going silent. Others were sending smaller amounts than promised. A few sent nothing at all. At first, the team blamed timing, holiday schedules, global conflicts, anything but the obvious, but the numbers kept sliding. When campaign finance reports confirmed a 27% drop in large dollar contributions from PACs tied to energy, logistics, and commodity sectors, Trump's inner circle could no longer look away. What had begun as a soft hesitation was evolving into a full-blown confidence crisis. Trump was briefed directly. According to multiple sources familiar with the meeting, he didn't react well. "Find out who's pulling back and why," he reportedly demanded, "and fix it." His advisors scrambled. Some called donors. Others called lobbyists. A few reached out to legacy funders who had been drifting away for months. But the feedback they received was chillingly consistent. One major donor with ties to a Gulf-based shipping consortium told a top advisor bluntly, "This isn't personal, it's practical. We've lost too much money in the last quarter to pretend this campaign isn't a risk factor anymore." That quote circulated internally. And when it reached Trump, sources say he was livid not because he disagreed, but because he knew it was true. His political instincts told him that narratives shape elections. His business instincts told him that losses shape loyalty. And his ego told him that someone had triggered this shift. In his mind, it wasn't just volatility or bad press. It was Warren Buffett. "He started this with that damn quote," Trump reportedly said to one advisor, referencing Buffett's now viral comment about donors pulling out when the math no longer worked. From that moment on, the campaign's internal posture changed. Behind the scenes, a containment plan was launched. Senior fundraisers were tasked with identifying the at-risk donor segments, particularly those with foreign exposure or energy sector links. Personal calls were made. Incentives were restructured. One advisor even floated the idea of offering policy previews to high-value contributors, early insight into upcoming announcements in exchange for renewed financial commitments. It was legal, barely, but it wasn't working because the issue wasn't access. It was instability. Donors didn't want more influence over a chaotic operation. They wanted less risk. And no amount of access could reverse the damage caused by Trump's off-the-cuff policy threats or sudden reversals. As this internal storm grew, a secondary issue emerged: the media. Buffett's remarks had shifted the narrative, yes, but it was Trump's reaction that made it stick. The more he raged behind the scenes, the more insiders leaked. The more he demanded loyalty, the more it looked like desperation. And in politics, perception is momentum. The campaign began tightening control on communication. Staffers were instructed to deflect any questions about fundraising volatility. Messaging shifted back to small dollar donations, patriotism, and grassroots strength. But inside the war room, they weren't talking about t-shirts or bumper stickers. They were talking about donor exits, FEC filings, and a growing fear. What happens if the money really stops coming? Because for all the bravado, all the noise, all the rallies, campaigns run on capital. And capital, once shaken, does not return easily, especially not when the people holding it have already started looking for the next candidate. By the time donors started backing away, legal analysts had already begun drawing lines between campaign finance irregularities and a much larger web of exposure. Because when major funders pull out, especially foreign-linked ones, it doesn't just raise financial alarms, it raises legal ones, especially when the exits coincide with ongoing investigations into foreign interference, shell company funding, and undisclosed political influence. For years, Trump's financial ecosystem operated in what legal scholars often call a gray zone, a legal space where campaign contributions, lobbying contracts, and corporate affiliations blur just enough to be technically compliant, but remain deeply suspicious in intent. Now that system was beginning to crack under its own complexity. It started when federal investigators began expanding their scope around Foreign Agents Registration Act, FARA disclosures. Originally aimed at identifying lobbyists working on behalf of foreign governments, FARA regulations had recently been applied more aggressively, particularly toward those with undisclosed ownership ties or influence campaigns. And that's where the foreign-linked donors came into focus. Several of the PACs and entities backing Trump had direct ownership links to companies or holding structures based overseas in regions ranging from the UAE and Qatar to Singapore and Cyprus. These links weren't hidden per se, but they were heavily laundered through layers of American LLCs, trust funds, and shell operations. This structure made financial sense. But legally, it was walking a razor's edge. One DOJ official, speaking off record to a Bloomberg journalist, noted that foreign capital routed through domestic facades is one of the most difficult forms of political influence to trace and the most dangerous to ignore. Warren Buffett understood this danger intimately. Though not a legal expert, Buffett's decades navigating financial transparency and shareholder regulation gave him a sixth sense for what might soon become a federal target. And what he saw in the Trump campaign's ecosystem, particularly the quiet exits of formerly loud donors, looked less like a strategy shift and more like a preemptive legal defense. When donors walk away from a campaign, they don't always do it for financial reasons. Sometimes they do it because their lawyers told them to. And in this case, that whisper was getting louder. Throughout October and November, legal teams representing various energy and logistics firms began tightening their compliance reporting. Internal emails circulated requesting updated FARA reviews. External audits were quietly commissioned to determine whether past contributions, though technically legal, might now appear coercive under new prosecutorial lenses. The concern wasn't just what had been done. It was how it would look if brought into court. Prosecutors don't need to prove a smoking gun. They only need to suggest a pattern. And when that pattern involves a presidential candidate, millions in foreign touched funding, and a series of policy announcements, that directly benefited those donors. It becomes a narrative the law can chase. Trump's legal team knew this. That's why, behind the scenes, they began coordinating with fundraisers to audit past donations and prepare talking points in case any future subpoenas emerged. Sources familiar with the operation said there was a push to identify all entities with foreign ownership greater than 25% that had contributed to any Trump-aligned PAC in the last 3 years. And more alarmingly, there was talk of donor immunity. Some insiders floated the possibility of approaching federal bloat investigators proactively, offering cooperation in exchange for protection. That kind of thinking doesn't happen unless someone's expecting a knock at the door. This is where the financial and legal threads intertwine. What had begun as a campaign funding challenge was rapidly becoming a legal exposure scenario, one where donors, campaign staff, and possibly even Trump himself could be forced to answer questions about the nature of the support they received. And Buffett? He wasn't surprised. In a closed-door conversation with a fellow investor, he reportedly said, "Once the capital pulls back and the lawyers move in, it's never about policy anymore. It's about survival." Because in the bigger legal picture, perception is liability. And the Trump campaign was now surrounded by both. To the public, Warren Buffett's comments about Trump's campaign and its foreign-backed donors seemed mild, strategic, maybe even cautious. He didn't raise his voice. He didn't point fingers. He didn't mention names. But anyone who's followed Buffett long enough knows this. He never speaks without intent. And this time, his message wasn't just about economics. It was about boundaries. In the now widely circulated CNBC interview, Buffett said something that most viewers overlooked. When money starts flowing from places that don't care about your Constitution, it's not just a question of influence, it's a question of ownership. That one sentence sent shockwaves through political finance circles. Because Buffett wasn't simply criticizing Trump, he was drawing a red line, quietly warning the American public, investors, and policymakers that certain forms of campaign funding might appear legal, but carry a moral cost too high to ignore. Buffett's background gives him a unique authority here. Unlike most billionaires with political opinions, Buffett rarely aligns himself overtly with any one candidate. He supported both sides over the decades, always emphasizing stability, transparency, and long-term policy. Clarity. To him, unpredictability is the enemy of markets. And in recent months, Trump had become increasingly volatile, not just politically, but financially. But Buffett wasn't interested in rehashing Trump's economic record. That wasn't his angle. What concerned him now was the growing entanglement of foreign capital with domestic decision-making, specifically how it was being laundered through layers of influence into campaigns that promised short-term deregulation in exchange for long-term vulnerability. In private investor briefings, Buffett expanded on this concern. He spoke about how several donor entities, especially those in energy, logistics, and infrastructure, had accepted quiet funding from offshore groups who weren't bound by U.S. law, U.S. values, or even U.S. economic interest. These entities weren't just hedging bets, they were planting stakes in the direction of American policy. To Buffett, that represented a dangerous shift. He referenced the early days of globalization, where foreign capital came into America to build factories, jobs, growth. But what he saw now was something darker. Foreign capital being used to bend American policy toward offshore profits. It wasn't foreign investment anymore. It was foreign extraction, and campaigns like Trump's were becoming the pipeline. When he made his public remarks, Buffett knew exactly what they would trigger. He knew donor exits would accelerate. He knew legal teams would start redrawing lines. And he knew Trump's circle would try to dismiss him as out of touch, old-fashioned, or politically biased. But Buffett didn't care, because this wasn't about politics to him. It was about integrity. He later told an inner circle of executives, once a campaign becomes dependent on money it doesn't understand, it loses the right to call itself independent. That line circulated throughout Wall Street. Quietly, investor confidence in Trump-aligned funds began to erode. Not because of policy, but because of optics. Fund managers didn't want to be in the headlines. Pension funds didn't want to explain indirect ties to campaigns under legal review. Public corporations didn't want activist shareholders asking hard questions about political risk exposure. Buffett's message had landed. not with a bang, but with a kind of surgical, targeted precision that only someone like him could deliver. It wasn't about yelling louder. It was about being the voice every smart person in the room stops to hear. And what they heard was this: there's a difference between capital that builds and capital that buys. And if America forgets that difference, its democracy won't be lost in a revolution. It'll be sold off one donation at a time. To Donald Trump, loyalty isn't just a political virtue, it's currency. Throughout his career, in both business and politics, Trump has treated allies, donors, and staff as part of a transactional ecosystem. If you back him, he rewards you. If you challenge him, he isolates you. And if you turn your back on him, he never forgets. So when whispers of donor pullback began surfacing, especially from foreign-tied funders who had previously propped up his campaign with enormous financial support, Trump didn't see it as a strategic pivot. He saw it as personal betrayal. From his perspective, these weren't just donors, they were partners. People he had met at private dinners, taken calls from at Mar-a-Lago, thanked publicly at rallies. In some cases, he had even shaped policy positions that aligned with their industries: oil exports, port deregulation, pipeline fast-tracking, relaxed energy sanctions. To Trump, this was part of the deal. He believed he had delivered on his end. And yet now, when the campaign needed renewed capital and unwavering loyalty, these same donors were ghosting his team, reducing contributions, or worse, funneling money into more neutral, non-Trump aligned conservative entities. Inside his inner circle, sources say Trump was furious. He began naming names in meetings. He owes me. She's nothing without my endorsement. We built his entire logistics business off that EPA rollback. In one high-level strategy session, an aide reportedly tried to explain that some donors were reacting to market turbulence and legal exposure, not a change in political allegiance. Trump cut them off. Mid-sentence, they're cowards. They made money under me and now they want to pretend they're clean? Please. But there was a deeper layer to his frustration. Many of the donors now stepping back had once defied mainstream Republican leadership to back Trump. Their loyalty had legitimized his outsider rise in 2016, fueled his 2020 comeback efforts, and now in his mind they were abandoning him just as new investigations and political attacks began to mount. What stung most was the silence. There were no public statements of support, no counter-narratives defending the campaign's integrity, no loyalty pledges on cable news, just a slow, coordinated distancing, the kind that only seasoned billionaires and global finance teams know how to execute without headlines. To Trump, that silence spoke louder than betrayal. He wasn't just losing money, he was losing control of the story, and nothing threatens him more than a narrative he doesn't command. One aide described the mood inside the war room during this period as vindictive urgency. Trump began pushing his media team to expose what he saw as disloyalty. Leaks began surfacing to pro-Trump, outlets suggesting certain donors were compromised or under foreign influence or working with never-Trump operatives. But the damage was done. Trump could bluster. He could rage. But he couldn't reverse the shift in sentiment among elite donors who now saw his campaign as legally vulnerable and financially unstable. And in that realization, something changed in Trump. He stopped seeing Buffett's remarks as an economic critique and started seeing them as a declaration of war from the old guard billionaires who had never truly accepted him. Buffett, in his mind, was the embodiment of the elite who thought Trump didn't belong in their club. So now, as the donations slowed, Trump didn't just feel politically threatened. He felt personally betrayed by the very class of people he believed he had brought to victory, the financiers, industrialists, and magnates who had whispered support behind closed doors, but now, under pressure, had vanished into silence. To Trump, this wasn't strategy. It was mutiny, and he would spend the next phase of the campaign not just fighting Democrats, but hunting down the loyalty he believed was rightfully his. When political volatility spikes, seasoned investors don't panic, they reposition. And that's exactly what began happening as the Trump donor narrative started to fracture and Warren Buffett's quiet warnings took root. While the mainstream headlines focused on campaign noise, court appearances, and cable news spats, the smart money began moving in silence. What investors are doing now reveals far more than what they're saying. The first move came in the form of portfolio de-risking. Institutions with significant exposure to Trump-aligned sectors, particularly energy, infrastructure, and private logistics, began subtly adjusting their allocations. This wasn't a full-scale withdrawal, but a tactical retreat, divesting from volatile equities, shifting capital into less politically sensitive instruments like municipal bonds and high-grade corporate debt. Why? Because politics, when unstable, becomes a market risk factor, and portfolios don't like uncertainty. Some of the earliest reactions were seen in emerging market ETFs that previously surged under pro-oil, pro-deregulation U.S. policies. By mid-November, fund managers began quietly rotating out of those positions, citing instability in the domestic policy pipeline. In plain English, they didn't trust the next White House to maintain the favorable climate. This sentiment bled into real estate investment groups as well. Luxury and commercial development funds in traditionally red states began stalling projects, particularly in areas where political unrest or legal complications could jeopardize zoning, tax credits, or federal funding. A Florida-based REIT even issued a memo to investors warning that the policy environment may undergo a rebalancing that necessitates a shift in exposure. But the clearest signal came from the private wealth sector. High net worth individuals, the exact class that had once cheered Trump's tax policies, began seeking legal and financial advice about distance clauses in their PAC contributions. These clauses, often buried in donor contracts, allow contributors to pause or redirect funds if a candidate becomes materially compromised by investigation or indictment. In effect, donors were asking, can we legally back away now? Some began redirecting funds to neutral Republican causes, think education, reform, judicial appointments, veterans affairs instead of Trump-aligned super PACs. These moves allowed them to retain influence in conservative circles without being directly tethered to a candidate under increasing legal fire. Meanwhile, venture capital firms and hedge funds began adjusting their forward-looking economic assumptions. One West Coast fund manager, speaking anonymously, said this: "We've completely removed Trump-era assumptions from our 2025 models. That includes tax exposure, trade protections, and interest rate advocacy. We're prepping for a completely different place in power structure." Others echoed this sentiment. Banking analysts began advising clients to prepare for a potential regulatory pendulum swing. Industries like crypto, private equity, and oil, all of which flourished under Trump's first term, were now being flagged for potential headwinds. If donors abandoned ship and the party leadership shifted toward more moderate or globalist candidates. Ironically, some of the quietest movements came from foreign capital. Sovereign wealth funds in the Middle East and Asia, once enthusiastic about pro-business Trump policies, began holding off on U.S. infrastructure deals, waiting to see whether Trump's influence would survive the donor retreat. A freeze on these investments didn't signal disinterest, it signaled caution. And through all of this, Buffett watched with the calm of a man who's seen dozens of booms and busts. To him, the market wasn't reacting to personality, it was reacting to risk perception. And the moment capital began to hesitate, the campaign narrative was no longer about winning votes. It was about containing losses. Investors, ever pragmatic, understood the stakes. They weren't making ideological decisions, they were making protective ones. Because if Trump became legally entangled in a way that triggered deeper investigations into donor networks or funding structures, anyone still tethered to his financial orbit could get pulled into the current. So what are investors doing now? They're stepping back, they're hedging, and most importantly, they're preparing for a future that might not include Trump at all. As the dust begins to settle around the donor retreat, legal murmurs, and Warren Buffett's viral warning, the question dominating every backroom political conversation and investor roundtable is no longer if the Trump campaign is destabilizing, but what happens next? Because when donors vanish, money dries up. And when the money disappears, so does political power. The first domino to fall is likely to be campaign infrastructure. Behind the headlines and rallies lies an expensive machine ad buys, data analytics, voter outreach, legal defense funds, and event logistics. All of it runs on capital. Without the high-dollar donor class, Trump's operation must rely more heavily on small-dollar grassroots supporters, a base that remains loyal, yes, but cannot match the war chest needed to counter mainstream Democratic fundraising. This financial pressure forces tough decisions. Do you scale back advertising in key swing states? Do you pull field offices from battleground zones like Wisconsin and Pennsylvania? Or do you stretch the budget thin, hoping for a viral moment to reset the narrative? Inside the Trump campaign, cracks are already showing. Staff turnover is accelerating. Consultants are demanding upfront payment instead of deferred fees. Vendors, once eager for exposure, now ask about payment guarantees before locking in contracts. But that's only one layer of the next phase. On the legal front, federal and state prosecutors are now circling with renewed momentum. With foreign-linked donors exiting, campaign finance investigators have begun revisiting past disclosures, especially those tied to shell companies or energy sector PACs. Some insiders predict that if one donor flips or cooperates, a chain of subpoenas could follow, pulling back the curtain on who funded what, when, and why. For Trump, that would mean navigating not just the political battlefield, but a legal minefield. And that's where Warren Buffett's real influence may resurface. Buffett didn't just warn the public. He signaled to regulators, watchdogs, and attorneys across the financial and legal world that something deeper was wrong, not just ethically, but structurally. And when someone of Buffett's stature implies that campaign capital has been compromised, doors begin to open that were once closed. Expect increased pressure on disclosure laws, foreign lobbying regulations, and possibly even a legislative push to limit foreign-adjacent contributions altogether. Politicians across both parties may now use Trump's unraveling donor base as a case study, a way to push reforms while keeping the media spotlight on their adversaries' vulnerabilities. Then comes the political fallout. If donor abandonment continues, we could see a realignment inside the Republican Party. Already whispers are surfacing about alternative candidates, not just governors and senators, but dark horse billionaires who present a cleaner option to the donor class. The more that financiers step away from Trump, the more power shifts toward post-Trump conservatism. This doesn't mean Trump disappears. Far from it. He still commands a massive base, unparalleled media reach, and the ability to set the narrative with a single post. But the equation has changed. Influence without infrastructure doesn't win elections. And as more institutional backers shift resources away from Trump and toward safer bets, his campaign may start to resemble a movement more than a machine. Which brings us to the wild card, Trump's response. Historically, Trump doesn't fade quietly. He retaliates. If he senses betrayal, especially from former allies or donor groups, expect a scorched earth strategy. He may name names. He may threaten legal action. He may even split the party or launch a third-party movement to maintain relevance. But each of those moves comes at a cost. The more chaotic the campaign becomes, the more unelectable it appears to the very donors. And swing voters needed to push through 2024. In that way, Trump's greatest strength, his refusal to back down, may become his greatest liability. So what happens next? A slow unwinding, a donor class in retreat, a legal threat growing louder, and a former president who refuses to play by the rules, even as the game begins to shift without him.